Thanks a lot. I'm happy to be here today. I'm currently a postdoc at Frankfurt University, just finished my PhD at the University of Zurich. And so this talk is going to be based on these three papers down here. All of this is joint work with my advisor Sven Zeuken at the University of Zurich and with Stefano Battiston, also from the University of Zurich. And this talk might be a little bit out of the ordinary. My work is on basically understanding financial crises using methods from computer science and finance. And I hope I can convince you that this is a very interesting topic that also falls into our field. So the motivation for my work is, of course, the financial crisis of 2008. You may know this picture, which has become kind of iconic for the downfall of Lehman Brothers in 2008. And the 2008 financial crisis triggered what is known as the worst recession since the Great Depression. So what you're seeing here is GDP growth in advanced economies over time, and you see this huge dip here, which is really without example in history. So regulatory authorities responded to that by new policies that were geared towards the perceived causes of the crisis. And this is what Janet Yellen, then vice chair of the Federal Reserve, said. Our regulatory reforms address the potential for excessive systemic risk arising from the complexity and interconnectedness that characterize our financial system. And I'd like to unpack this statement a little bit. So systemic risk is just the risk of a financial crisis, any risk that a financial crisis might appear. And now I want to talk about the next two things. Let's first talk about interconnectedness. And the basis for that is that the financial crisis has shown that a very good way to think about the financial system is probably as a network structure that consists of nodes, which are financial institutions, or I just say banks. And the edges of the graph are financial contracts, which define some obligation to pay money under some conditions. And now the problem with this is, of course, that financial distress at one bank could spread through the network to the next bank, and from there on and on and on, and cause a systemic crisis. And this is how interconnectedness drives systemic risk. So now we've understood these two words. And where I started with my PhD research was about this other word, this complexity word, which is used in a very informal way here. And the way I wanted to approach this is by looking at what these contracts really are, because the way they have been modeled in the past is by just weighted edges, basically, in this graph. And especially in the years leading up to the crisis, they were not really just single numbers, but they were to a large degree what is called an OTC derivative. So OTC stands for over the counter, so directly traded derivatives, directly traded between banks. And an OTC derivative is just a contract between two banks, A and B, where some money has to be paid dependent upon some variable or event. And this variable or event could be anything. It could be an interest rate, it could be an exchange rate, it could also be the default or bankruptcy of another financial institution. Or other things. And in the years leading up to the crisis, the amount of OTC derivative has increased very greatly. And actually the US Financial Crisis Inquiry Commission stated that that OTC derivatives significantly contributed to this crisis. So my overarching research question, actually for my whole PhD, was if we look at a financial network that does not have any derivatives in it, so where all the contracts are just debt between two banks. So there's an obligation like, I have to pay a certain fixed amount to you. And then I have a financial network that does contain derivatives. How can I somehow capture in which way a network with derivatives is more complex, and what are the implications for systemic risk in a way that should be made precise using formal tools. So in the two papers I want to talk about today, we studied financial networks that consist of two types of contracts. The first one is just a debt contract. A has to pay a fixed amount to B. And the other one is a derivative that is called a credit default swap, or CDS. And I want to motivate this starting at a debt contract. So let's say A owes an amount of $2 to B, but B may not be so sure that A can actually pay that, and they may want to buy an insurance from a third bank, C. So let's think about what the payment in this derivative should be. So if A can pay 100% of this amount, then the payment here should be 0. If A can pay 0% of this amount, then the payment here should be the full amount, which is $2. And in between those 2 points, we interpolate linearly. So in the end, the formula is whatever is in the contract times 1 minus, and then this percentage that A can pay, this is called the recovery rate. So 1 means can pay everything. So this situation is called a covered CDS. In a real financial market, this edge would not have to be here, and then it's called a naked CDS. So this is a CDS that's just without anything else. One interesting fact is that in the financial crisis, there was a situation that was like this. So there was Lehman Brothers, and there was AIG, and AIG had sold huge amounts of CDSs on Lehman Brothers. So when Lehman Brothers came close to default, AIG would not have been able to pay this. And so in the end, AIG was saved by the government also to protect these buyers of CDSs on the other side. So these are the kinds of networks I want to look at. So they look like this now. We have these debt contracts here in blue, and we have these CDSs in yellow, like here, where banks sell protection on other banks. Now we operationalize complexity of these networks in terms of what is known as the clearing problem. That's the following problem. We are given a financial network, and that's encoded as follows. So we have a set of banks, and we have a collection of contracts. And the way we encode these contracts is just that we say, for any possible debt contract between banks I and J, and for any possible CDS that there could be, we just store the amount of the notion of that contract. So how much of this contract is being written. So if we only have these things and we don't have these things, it would be a standard weighted graph. And then we assume that all of the banks also have some external assets, so you can just imagine them as cash. The story behind these external assets is usually that they were reduced from some prior high state to some low state now because the system was hit by a shock. But we leave this implicit. What we want to find are the recovery rates of the banks. So to remind you, these are the percentages of liabilities they are able to pay. And this will tell us whether or not a bank is in default, meaning they are bankrupt, they are not able to pay everything, and then kind of how much. Now, in a network, this is actually a non-trivial problem because how much, let's say, I can pay to someone else, well, this will depend on how much I receive from other people and also how much I owe to other people in total in case I'm writing any CDSs. So what we are facing here is a fixed point problem that looks like this. The recovery rate of a bank I should be 1 in case the assets, so what it has, is greater or equal to its liabilities, what it owes to others. And otherwise, this bank will be bankrupt. And so the recovery rate will be the quotient of the two. I want to introduce one final complication here, which are costs of bankruptcy. So the idea would be that if a bank is in default, it incurs additional costs, and this could be because it cannot operate efficiently, because it has to sell off some things it owns quickly. There might be legal costs involved and so on. And the way I'm encoding this is I'm just saying that there are 2 additional default cost parameters, and if a bank is in default, then its assets are reduced according to these factors. So they are just multiplicative factors. And so I don't want to keep it a secret what exactly these formulas are. They look like this. I don't want to go through all of it. But what you see, for example, is that to compute, let's say, how much bank I gets from others in a CDS, it has to take the recovery rate of the reference entity, and then you have this 1 minus this thing, you multiply by the notional of the CDS, and then you need to multiply by the recovery rate of the person writing the CDS, right? Because if I hold insurance from someone, but the one selling the insurance to me is also bankrupt, I'm still not receiving anything. So this clearing problem has been used in a lot of prior academic work, but it also had some practical relevance. And there is some account by Joseph Stiglitz. So there was a crisis in East Asia in 1997. And Joseph Stiglitz was chief economist of the World Bank. And this was before he got his Nobel Prize in 2001. And so he was basically tasked with resolving the network of obligations that existed back then. And about this task, he said the following. This was an extraordinarily complex general equilibrium problem, and it actually, like in the context of what he's saying, it is very similar to the clearing problem. That had not been solved. This led to a paralysis, and the delay in restructuring was extraordinarily costly. So not being able to solve the clearing problem seems to cause actual economic damage. Fortunately, the reason Stiglitz couldn't solve the clearing problem was that he was just too early. So in 2001, there was the first axiomatization or modeling of this problem for debt networks. And here, so there are no derivatives here. And here the problem has two very nice properties. The first one is existence, so solution always exists. And the second one is what we call maximality. This means that there might be multiple solutions, but there's always one solution that sets off each bank best. So people will not argue about which solution should be chosen. Yes, exactly. It's a lattice structure. Yeah. And so the first result we obtained here is that as soon as you introduce CDSs, these properties do not hold anymore. And I want to show you a very simple example, as simple as possible, or as simple as I could make it. So here we have 4 banks, A, B, C, D, and A owes $1 to D, B owes $1 to A, and we have a CDS from C to B on A. And just to make it simple, I'm assuming default cost of 100%. This means that a bank is either fine and can pay 100% of what they owe to others, or they lose all they have and they can pay 0. So the only two possible recovery rates are 1 or 0. We have, in the paper, we have more general examples. And now I'm going to show you that for bank A, both of these cases are impossible. So let's first look at the case where the recovery rate of A is 1. So A is not bankrupt. Then this CDS doesn't have to pay anything, right? Because it's 1 minus recovery rate. So bank B does not have anything and cannot pay anything to A. But this means that A does not have anything, and therefore its recovery rate should be 0. And that's a contradiction. The other direction, if the recovery rate of A is 0, then this CDS will pay everything, so B can pay everything to A. So A has sufficient assets to pay this contract, and the recovery rate should actually be 1. And that's a contradiction too. So here, the clearing problem has no solution, and we have this phenomenon we call default ambiguity, because it's not defined whether A is in default or not. So I'm successively filling out this table. So we just saw this. There's also a counterexample for maximality in case a solution exists. And so going back to the original question about complexity, this difference here seems to indicate to me that financial networks with derivatives are in some way more complex than those without. One side note, if you don't have default costs, you actually get existence, but the way you get it is because of a fixed point theorem, because then your the function you're looking for, the fixed point of, is continuous. And so you can apply a fixed point theorem, but this proof is not constructive. And I'm going to come back to that later. One thing we did here is that we looked at restrictions on the contract space under which one or both of these properties can be recovered. And the main insight here was that you have to distinguish between covered and naked CDSs. So to remind you, a covered CDS looks like this. So you have the CDS together with the debt contract. And this gives rise to a situation where if Bank A is doing worse, then overall Bank B will also be doing worse. And this is also what is known as a kind of long position in finance. So worse maps to worse. If you have just a CDS, so that's a naked CDS, if A is doing worse, then the insurance payment for B increases and B is actually doing better. And this would be called a short position in finance. So the main result here is that if there are no naked CDSs, then both of these results are guaranteed. And the proof is actually the same as in prior work. You get this kind of lattice structure that you mentioned because you can exploit monotonicity of this function we are looking for the fixed point 4. We extended this method in one way. We went one step further. What you can actually do is you can map out, following a set of rules, all of these long and short positions into a graph structure, and then we can obtain additional sufficient conditions based on that. So this was the first paper. And the second paper, in the second paper, I asked a question that may be obvious to a computer scientist and is another lens for complexity, maybe for any other person, which is the computational question. So it is known from prior work that in the case with only debt contracts, we don't just know that a solution exists, but we also have a polynomial time algorithm to compute it. So this actually computes this maximal solution up here. And we asked, how does that change with CDSs? And this actually needs to be asked in two parts. So in the case where we cannot be sure that a solution exists, we looked at the corresponding decision problem. And in the case where a solution always exists, we looked at the corresponding search problem. And so the result is that both of these problems are hard. We actually need to reformulate this a little bit. So these will be approximation problems in this search case. It turns out that this is a PPAD complete search problem. Falls into the same class of complexity as finding a mixed strategy Nash equilibrium of a normal form game, for example. And for the decision problem, we also look at a relaxation of this. So the way this is proven is by reduction to circuit problems. Here we reduce to Boolean circuits to satisfiability in Boolean circuits. And here we reduce to what is known as the generalized circuit problem. And I want to show you one gadget just to give you the feel of that. And this is how we encode addition. So the way this works is as follows. This is a gadget where we have some bank V. This is an output bank. And the recovery rate of this bank will be the sum of the recovery rates of two input banks, A and B, capped at 0, and then plus minus some error term. And so one thing you're seeing here is that the way we connect the input banks to the gadget is by CDS references. So the connections are not let's say the kind of information that flows into the gadget is not along payments, but using CDS references. And this is something very convenient because it doesn't change the assets and liabilities of these banks. And then you see that there are some intermediate banks here that do computation. The assets of these banks are always CDSs and the liabilities are always constant, so that's also very convenient. And then in the end you have the result, and this may be connected by a CDS reference to the next bank. And that way we can create a kind of circuit that does computation. So again, that seems to indicate that we have an increase in complexity here, and this is also formalized as computational complexity. So computational complexity seems to be a very useful tool to formalize this intuitive notion of complexity. There is one more thing we can do using these restrictions, and so we were asking, where does this complexity come from? Like, what is really the source? So one thing we found is that, again, naked CDSs seem to be the culprit if you don't have naked CDSs. then you get a fully polynomial time approximation scheme that looks as follows. You start by assuming that every bank can pay everything. So you start by assuming recovery rates are 1 everywhere. And then you just recalculate the recovery rate of each bank based on the recovery rate of others. And you just do this iteratively, and you converge to the maximal solution. And then we have 2 other results that I'm going to skip in the interest of time. Right, and so this is in this paper. We're currently working on a journal version of that. To conclude, I asked the overarching research question: in which way financial networks with derivatives are more complex than financial networks with only debt contracts, and how we could formalize that. And I showed that CDSs create this default ambiguity. CDSs increase computational complexity of the clearing problem. And if we're looking for anything like an origin of this complexity, then it should probably be naked CDSs. Instead of future work, I want to mention 2 pieces of ongoing work I'm currently working on and that I would be very happy to discuss with any of you over lunch or coffee or whatever. The first piece of ongoing work is about something called portfolio compression. And this is the following process. You have a financial network, and there are cycles in this network, like this one, for example, and you remove it. And I'm interested in how this affects systemic risk in a way. This is something that's actually been done, by the way. This is a process that is currently happening in the financial industry. And the other one is on market design for algorithmic trading, where you have traders that are fast and traders that are slow, and I'm interested in the interaction. Thank you very much for your attention.
Questions? Okay, I have one. So, say that you are able to find a solution with these rates. Is there any system in the real world to actually implement that? Because it requires like coordination of this entire system concurrently, right? Like, are there laws that enable that?
Mm-hmm. Okay, so I guess I should repeat the question. The question was, is there any real world, let's say, correspondence to the clearing problem? Yeah. So I think it is a model for financial crises. So in the real world, if you actually want to do clearing, I think you need something like the East Asia crisis, for example, where they actually try to do it. I believe one other very important application is when you're trying to simulate a crisis and you want to do something like a financial stress test. So this is something that the European Banking Association or the European Central Bank is actually doing, where they model the financial system and they want to understand how it would respond to a shock, and they also want to understand like which banks would respond most to a shock, which are the critical banks, and so on. And this is something that is being done, among other techniques, using one of these clearing approaches at the moment, relatively close to the literature actually, but in a debt-only model. So we are still in this kind of world. And so these results help us understand, could we just extend these techniques? Could we do reasonable stress tests with derivatives? And it seems to be much harder.